Investing isn't just about luck, it's about knowledge. Security Analysis by Benjamin Graham and David Dodd is like the ultimate textbook for serious investors. It's full of deep financial insights, but we're going to focus on 3 lessons that will completely change how you look at stocks. Everybody's looking for the secret to successful investing, and Warren Buffett himself swears by this book. Stay tuned because we'll reveal an easy method to ascertain a stock's value. Graham and Dodd's first lesson is to understand intrinsic value. Think of it as the true worth of a company, separate from what the stock market thinks it's worth. Imagine buying a house. You'd look at factors like its size, location, condition, things that give it real value. Stocks are the same. Graham and Dodd say that to find a stock's intrinsic value, we need to look at earnings, assets, and the company's financial health. To get started, check out the company's cash flow statements, net income, and debt. Websites like Morningstar or Yahoo Finance provide these details. While it takes practice to estimate intrinsic value accurately, you'll develop an instinct for spotting good deals over time. And remember, at the end of this video, we'll share a free tool that people spend thousands of dollars on courses to learn about, but you can get it here for free. Lesson 2 is about the margin of safety. This is essentially your buffer zone. Graham and Dodd recommend only investing in stocks priced well below their intrinsic value. Think of it like buying clothes on sale. If you know a jacket is worth $100, you'd be thrilled to buy it for $60. Similarly, buying stocks below their worth gives you a cushion if the market dips unexpectedly. Look up a stock's intrinsic value and set a target price at least 20% below it. This way, you're protecting yourself from unexpected volatility. Finally, Graham and Dodd emphasize a long-term approach. Stocks can be unpredictable day to day, but if you invest based on value, the price should reflect it in the long run. Take Coca-Cola. Over decades, it's grown because it's a solid business with brand power and reliable earnings. Investors who bought it for long-term value have seen incredible gains. To sum up security analysis, understand intrinsic value, buy with a margin of safety, and think long-term. These principles have stood the test of time and can help you make confident investment decisions. If you're keen to know how intrinsic value is calculated, there are different lenses to look through. One popular method is the discounted cash flow (DCF) model, which involves estimating the future cash flows of a company and discounting them back to their present value. Another approach is the dividend discount model (DDM), which focuses on the dividends a company is expected to pay out. For a simpler yet accurate method, consider using the earnings multiplier approach. This method involves multiplying the company's earnings per share, EPS, by a suitable price-to-earnings, PE ratio. It's a quick way to get a rough estimate of a stock's intrinsic value. Next up, before we show you an easy way to estimate a stock's intrinsic value and present to you the free tool, don't forget to hit that like button and subscribe the channel. In this chapter, we will demonstrate how to calculate the intrinsic value of Coca-Cola, KO stock, using the discounted cash flow, DCF, method. We will make the following assumptions: a growth rate of 4%, a discount rate of 8%, and a terminal growth rate of 2%. Let's dive into the calculations and understand how these assumptions impact the intrinsic value. First, go ahead and download the Google Sheet from the description. Then, go to Yahoo Finance and get the current free cash flow figure. Next, go to Balance Sheet and retrieve the shares outstanding for Coca-Cola. Key in all the relevant fields in row 2 of the Google Sheet. The Google Sheet will calculate all the future cash flows and the present values using the relevant growth rates and discount rate. There is also the terminal value, which is the value of all the future cash flows beyond the 5-year projection period, assuming a 2% terminal growth rate. We will then arrive at the intrinsic value of Coca-Cola stock, which is about $42. This figure can then be compared to the current market price to determine if the stock is undervalued or overvalued. Keep in mind that market conditions and assumptions can change, affecting the intrinsic value. You can download the Google Sheet with detailed workings of this calculation from the link in the description for free. Remember though, this is just one of the methods to value a company's stock. Dear viewers, if you found this video helpful, please like and drop a comment below. Your support encourages us to create more detailed videos on calculations and other investing topics. Thank you. We also invite you to join our growing community of investors by subscribing to our channel. By doing so, you'll never miss out on our latest insights and tutorials designed to help you make informed investment decisions. And remember, investing is a journey, not a destination. By continuously learning and applying these concepts, you'll be better equipped to navigate the financial markets with confidence. Happy investing, and see you in the next video.